Yo, another day in paradise. My apologies for missing the show on Friday. I was really exhausted. I've been doing this, doing workouts twice a day in the morning and then going to the gym afterward and then getting to the studio. And I put in quite a lot of work last week. Not to mention there's a lot of stuff in the business world that's been kind of picking up for me as of late. So because of all those things, I was just exhausted. I was worried that I was getting sick, but I'm not sick. I'm good. Just need a little bit of sleep. Probably smart to check the health app and see how fatigued I was. I track all that stuff because I wear the Apple Watch all the time. But anyway, you're not here for that. You're here for the Higher Standard Live. I'm your host, Kristen Hebe, and we give you everything that CNBC gives you in approximately 30 minutes. I'm tightening that up from what used to be an hour-long show. I think it's better for the algorithm, better for you. For those of you who can watch the recap, we are seeing an oil surge. It started over the weekend. There was a lot of, uncertainty around the ceasefire or lack thereof in the Middle East. And because of that, we saw some surges in oil, and we're seeing the resulting impacts to the market today, which largely appears to be defensive and hiding in safety. So let's go ahead and start off with the top, the things you need to know. Okay, this show is brought to you by the team over at Fridays. Go to joinfridays.com, use code HIGHER, get $100 off your first order. I'm on it. You should be on it too. It's great for longevity, health, and frankly, all the good things. And for those who are not fans, don't knock it till you try it. That's what I always say. Let's get in to the market status, baby. There you are. Defensive positions hiding in safety as to be expected. I don't think anyone's really surprised by that. You've seen some pretty interesting things happen, which we will cover in the XAI portion about top headlines. Obviously, it's all about Iran and ceasefire, global oil tensions, and geopolitical risk are on the rise once again. So the Dow, S&P 500, NASDAQ, Russell QQQ, all down on the day. This puts us and our Chiron here at defensive positions, pushing towards risk off, although we've seen some optimism in the markets, largely led by tech. So I think we're going to see some interesting things happen as this whole ceasefire or lack thereof continues to escalate in the coming days and weeks. But for right now, this, I guess, love affair with the ideology that this is going to go away relatively quickly and easily seems to be falling apart, and you're seeing that in the markets. The synthetic volatility index, what's going on? Why is that not pulling up? That was weird. My synthetic volatility index is not popping up. What? Interesting how everybody else is working. All right, well, synthetic volatility index, which actually let me check real quick just to make sure I didn't load that wrong. Synthetic volatility index risk. It is supposed to be appearing. That's interesting. Let me try this real quick. There you go. See, you can always fix stuff. We are showing calm on our synthetic volatility index, and the reason why is because we look at the kind of the macro market, and I think this does align with a lot of what we're seeing in the overall bigger picture here. Now we are seeing the VIX start to pop up a little bit here. That's the VIX right there. You're seeing it a little bit higher than it once was. It was down to about 17. We're now sitting around 18 for the day. So anything below 20 is still what I would call general comfort level with the markets, but rising fear, rising concerns about what's going on here. And the market's been in disbelief. So me seeing this here does not necessarily scare me a whole lot. As a matter of fact, when I look at something like our synthetic volatility index here, it tells me that you've got some pretty interesting trends in the day that seem to suggest that while people are worried about what's happening with the geopolitical conflict, even though the market's kind of defensive and hiding in safety, that they believe this will pass as of right now. If their conviction as it relates to uncertainty and the lingering inflationary concerns continues to be realized, I think you're going to see this pivot down into the high 60s, low 70s, which would signal a pretty significant shift in the behavioral economics, really driving the market, if that makes sense. So before we get too far down this path, I want to get into some of the basics that we're going to talk about here. Liquidity has gone back into restrictive after the last FOMC meeting. This was predicted by them. The non-QE, QE has stopped, and because of that, you're in a net restrictive policy, effectively draining liquidity from the system as opposed to putting it in, which is not going to be good for inflation. It's going to try to bring that down. Less money in the system means less spending. Less spending means less propping up of these values. I don't think it's going to have the impact. I think inflation is already having its impact from other things we're going to get into later on in the show. Mark Zandi did a great piece on this, going all the way back to Liberation Day and showing how inflation and jobs have reacted post-tariffs. I think that's going to be a very constructive part of the conversation. That is also in the show notes if you want to take a look and get ahead of things here. Home affordability remains to be stretched. We're not seeing a whole lot of movement here. This is one of those charts where it really bothers me. Not a lot of updates to this. It really is updated quarterly as they present more data. So I'm probably not going to reference it a whole lot on future shows until I find a way to look at more real-time data. I am a real estate broker, so I'm thinking about pulling some of that stuff in from MLS and maybe finding a better data source for contracts than what we're currently seeing in the home affordability. And again, this is real-time data from the Fed, so in theory, this should all be up to date, but I'm not exactly impressed with it. The macro week coming up ahead is going to be pretty sanguine, if you will. We got ISM manufacturing data, nothing really big here, balanced trade, some crude oil stuff here, the stock change. That's going to be interesting as we see some of that stuff develop. 30-year mortgage rates, ISM server, JOLTS has been probably the biggest one on Wednesday. Everything else is relatively innocuous. We got some non-farm payroll. So really, in my mind, the JOLTS job openings report on Wednesday, so jobs and payroll and unemployment rate on Friday are going to be your biggest one. So think of Wednesday JOLTS and Friday jobs. That's going to affect your non-farm payroll, your CPI expectations. It's going to be a big macro trigger. Let's get into the sectors. Everything is going to be down today, but it's not just because of the geopolitical constructs. It's because you got some weird action going on in the bond market, okay? So what does that mean to you, to me, everybody else? It means higher mortgage rates most likely are on the horizon and in your future. If I look at the 10-year Treasury, which we're going to look at right here, you're looking at up incrementally about 66 basis points-ish. That's 4.44%. Again, mortgage rates typically trade between 1.8 to 2% over, even though there's been some margin compression recently for a 30-year fix. That's approximately 6.24 to 6.44% average 30-year mortgage rate based on what we're seeing today. And that is an increase up. I think you're going to continue to see that increase go up until such time as there's more conviction, belief in a ceasefire. It seems as if the White House has burned through its, I guess, stated political capital on there being possibilities of forming some type of ceasefire soon, particularly because there is rumored to be a strike on the UAE this morning, which involved drones, which would be counter to what we're hearing. And this is where I would pause and say to everybody else, look, there is a vested interest in the media and everybody else in keeping back the narrative of what's happening. And you've seen a palpable downturn of reporting on the Iran war. And I think some of that's going to prop the market up. Some of that's just because people aren't telling people. The government has no need to tell people about what's going on over there as vividly and honestly as they otherwise were before, because it's clearly that they're not getting traction here. And some of it might just be they don't understand who's in charge there. I mean, you did take out the entire leadership team there. Oh, by the way, hey, new lights in the background there. You like that? It gives me a little more, I guess, depth in the shot, if you will. Anyway, so yeah, who knows what's going on over there? That's the problem, right? Is if you don't know what's going on and you're trying to rely on the idea that somebody from that organization, which is the country, is going to be, signing a ceasefire, who's that going to be? And do they have the authority to do so? And that remains to be seen. So all of this talk about things, effectively going quiet. Well, Russia-Ukraine war still going on, Israel and Palestine still going on, and now this war is still going on. You're just not hearing about it as frequently. So I would give everybody a great deal of caution before you take solace in the idea that this thing is winding down. I don't think that really is the case as of right now. It could just be a slow slump, or it could be a ceasefire. So rate sensitive demand, as a result of what we're seeing here in the bond market, is starting to show some pretty palpable impacts to the home builders, D.R. Horton, Lennar, Pulte Group, NVR, all impacted in what is a pretty obvious way. And that does align with the market status of the day. So shouldn't be any surprise there if you've watched the show for any time. Banks are going to be down on the day as well, largely because they think there's some deteriorating credit conditions in some of these markets, but also because of the interest rate impacts. But again, this is because the entire market is having this mixed day defensive position. That you might see a rally towards the end of the day. There's been some really positive news with some of the tech sector, so that might lift up a little bit here. But I don't know that we're going to see it by the end of today. We got a couple hours left in the trading day. Commercial real estate REITs are going to go along the same lines here. Mega caps, these are your tech companies. They're doing okay. Microsoft, Nvidia, Apple, Alphabet, all doing largely okay relative to the rest of the market. Apple being hit the hardest. But again, you had the S&P 500 reporting on, I think it was last week, middle of the week. I'm sorry, you had several large tech companies, about 20% of the S&P 500 reporting last week. So you saw a little bit of lift from those sectors. You got some consumer stuff here. This is one of my favorites. You know that. Home Depot getting hit hard. There is a nexus between Home Depot and home builders. You have to be cognitively aware of at all times. If housing takes a hit, home building takes a hit, consumer discretionary takes a hit, but then all that excess consumer spending typically goes into these necessity companies, which I am a big fan of, at least in this current market, although I am still a fan in banks too. Industrials, Caterpillar, Deere, General Electric, Union Pacific, 3M, nothing really trending here, although there is some consumer relative and construction relative businesses that are being impacted. I will say Deere has been relatively resilient in recent quarters and months. Let's take a look at the energy sector. Obviously going to be positive, right? It's going to be the only positive impact today. Schlumberger, I'm not a big fan of. They always somewhat, I guess, agnostic to the market. But Exxon, Chevron, Conoco, EOG Resources, all positive based on what they think oil prices are going to do. And of course, the natural logical question is, Chris, what are oil prices doing? Well, they are rising once again, and the reason why is the conflict and the uncertainty that we just talked about, and we've seen this play out several times over the last month or so. So this should come as no surprise that you're seeing oil now. This is crude. I tend to track crude versus Brent, but you can track either one. $105.21 is up. It's up pretty meaningfully, $3 a barrel there. So you're seeing a pretty big lift there. Let's take a look at Brent as well. Brent 113. Again, we saw sustained growth here with this dropping down into the 80s, going back up to the 120, I think, number at one point in time. And that was, let's go look over here at the, let's say, 1 month chart. I think it's going to show you the volatility. Yeah, there we go. So this is your 1 month chart for Brent oil. I'm sorry, for crude oil. God, it's been one of those days. And there you go. This number, just so you know, is 105. And it peaked up here at, let's see what this is. That is 106, 109. So yeah, I mean, anything that's sustained in and around this region for a prolonged period of time is going to have oil shocks. This affects helium. This affects sulfur. This affects microchips. This affects food. This affects everything. Did a great video on this, the stagflation versus inflation, the Strait of Hormuz, in our THS educational series. We got more on that series coming. I hope you liked it. Okay, so let's get into one more sector, the defensive positions. This is where the money goes. Everybody's looking to run and hide. I don't think that we're seeing a whole lot of fear right now for capital preservation. I think people are getting defensive. You start to see capital preservation when you get into those two categories, risk off and liquidation. We're not there yet. This, to me, just signals a broad step back and people going, okay, where's the market going? Where's the money at? And how is this going to impact what we're investing in? So these seasoned investors, I say they, like everybody knows what I'm talking about here, They're going to look at the macro environment and they're going to say, okay, now's the time to say, okay, what happens if this, then that kind of logic, right? So if there's not a ceasefire and this war continues to escalate, what does that look like for the macro sector? And if it de-escalates, what does that look like for the macro sector? How does that impact me? And they're going to look at some of the reports that come out as well, CPI, for example, and some of those figures. We're going to spend a little bit of time today talking about inflation and how it may be too late to avoid a recessionary economy, and some of the reports that came out, some of which are funny. Some McDonald's making some material changes, which breaks my fucking heart, but that's a different conversation. Dating has gotten, shocker here, really expensive. We're going to get into that. And we're going to get into something by Mark Zandi about the Liberation Day post-analysis, about 1 year post-mortem that he presented. But before we do that, we're going to get into one of my favorite parts of the show. It's the XAI portion of the show. The number one topic here should be no surprise: Iran and UAE drone attacks. Iran launched missiles and drone attacks on the UAE oil facilities in, I can't say that, causing fires and threatening the fragile ceasefire. The U.S. military responded by eliminating Iranian boats in the Strait of Hormuz. Now, I'm going to be the guy here who says it, okay? If you have a ceasefire and you are still firing, then you do not have a ceasefire, right? But let's see what our old friend Opus 4.7 has to say about this. Despite oil spike to $119, consider this may be temporary, as strategic petroleum reserves could be deployed to stabilize markets, and it likely will, but that doesn't mean that the inflationary shock from this will be avoided. If anything, you're going to deplete oil reserves down to a meaningful point. Now, if you're in the Midwest, I talked to some of my family out in Oklahoma, and some of these gas stations that are the smaller ones are out of oil. Out of oil. Some of the last tankers coming in prior to the Strait of Hormuz debacle have now landed in Long Beach at the port. And you're going to start seeing some material impacts. People are going to say, well, Chris, look at all the travel spending. People are still spending on consumer discretionary travel. Yeah, there is actually not a real big material connection historically in the data, at least that I've been able to see, showing oil cost and a slowdown of travel. It usually has more of a trickle-down effect over time. I think the airlines are going to get hit anyway because of what's happening with Spirit, but certainly I think that this is going to be 6 months from now, you're going to go, oh, that's what the oil shock did. I think everybody's looking too narrow in time to really appreciate it. And I think there's such a multitude of factors impacting the economy right now that puts all of this on a long duration pain curve ahead that I think too many people are frankly just ignoring because it's just not in front of them. And we've gotten to this point as a society where we invest like we view content. We get on our phone and we scroll, and it like holds our attention for 15 to 30 seconds, and then you move on. And that isn't the way it works anymore. So one of the things people need to get comfortable with, and this is probably as good a time as any to talk about this, is that we associate Silicon Valley with these big investments into companies like OpenAI, into Anthropic, and you associate Silicon Valley with these tech startups that just make all this money. You associate Hollywood with media, and it's really easy to go, okay, wait a minute, those two are very disconnected worlds, but they're not. Several decades ago, a lot of Hollywood started to say, okay, well, I can use my star power to pull in to investments, right? So you got Ashton Kutcher out there. You've got a number of very successful people out there that are investing in and around these spaces, using their star power to bring attention to Silicon Valley. During the last election cycle, you saw Joe Rogan with his podcasts almost single-handedly change the momentum of the election cycle. And I think there's been some very keen awareness that those two cultures are now merging. I think A16Z is a great example of this, right? They're just as much of a media company as they are a tech company. So as much as you think of venture capital, well, if you're a venture capital company and you put a ton of money into startup technology and ideology, that's great. But if you can do that and control a narrative around these products, you can also sell your own sizzle, if that makes sense, right? You can sell it into it. So we just saw OpenAI by TBPN, which was an 18-month-old podcast for what's presumptively, I think, over 100 million, below 200 million, somewhere in that range. And they didn't have a long track record. They were making money. They got some good people behind them. The pedigree's all there. I'm not knocking them, although I am jealous as shit. But what I will tell you is that is going to be a resounding theme where a lot of what you would essentially call venture capital firms or private equity firms are going to figure out that owning a media outlet, owning a way to speak directly to you, the consumer, and control a narrative including social media, is going to be how they drive traffic. Because one of the things that we often do is go, okay, this is a good investment. People should know about it. We're going to put our money into it. Well, look, you got a war, geopolitical conflict with the United States. Unlike Israel and Palestine, unlike Russia, Ukraine, we are a direct participant as opposed to a shadow participant in this war. So it is depleting our tax dollars. It is impacting our financial situation as a country because we are embedded in this war. Not to mention the risk, the health, the safety of the people. There's a whole lot there to unpack. I'm not diminishing any of it. But what I am saying is that we've turned to a point where society gets emotionally tired quickly. And you don't connect the investment with the exhaustion. So what do? You say, I just don't want to talk about the awards anymore. I'm just going to go back to investing like normal. And the market is resilient. And you see this almost deniability or false belief or even arrogance, if you want to call it that, in the markets because people are saying, you know what, I haven't lost for 20 years. Well, nobody's lost for the last 20 years. So you've 15, 16 years of artificial interest rate deflation, one of the greatest runs of all time, market at near highs. People today on CNBC are still talking about the Dow hitting historic highs, the S&P hitting historic highs, and you're like, wait, what? Like, is there no concerns about headwinds? And then we're talking about IPOs hitting monumental changes, and you're like, wait, this doesn't make any sense. But they're talking about the S&P hitting 8,000 this year, and you're sitting here going like, okay, wait a minute, how does that happen? How do you get the S&P, and it's obviously IPOs of some of these companies, which seem to be very much overvalued relative to, other established companies with the same market cap. So again, I'm not diminishing any of this. I'm just saying the way we view things has changed, and because that lack of attention span has changed, I think the market now moves in a different way because we are being programmed by this technology, not the other way around, okay? So oil prices, of course, number 2 on the XAI surge here. Brent crude oil prices surge over 6% to $119 a barrel following the Iran attacks in the UAE, which is not getting a lot of headline coverage in traditional media today. Energy infrastructure remains at risk in the region. Oil spike creates inflation pressures, but may benefit domestic energy producers and refiners. Yeah, it may benefit domestic people, but let's not forget that the UAE left OPEC. So that's a problem. Of course, number 3, we kind of teased this a little earlier. Bond market stress. U.S. bond market yield surges to 4.45 on 10-year notes as geopolitical tensions drive flight from bonds. Yeah, that's not good. Market now pricing no rate cuts into December 2027. As a matter of fact, JP Morgan, David Kelly, my guy, and his team over there were calling that there would be no rate cuts. As a matter of fact, there'd be a rate increase in March of 2027, which seems to be an increasing possibility based on everything that we've seen so far. And I don't know that Warsh is going to have the backing, the votes, or the economy behind him to cut rates, even if there's more votes there. There's just too many members of that committee who see things otherwise. Extreme positioning against bonds may create contrarian opportunity if geopolitical tensions de-escalate quickly. I do not see how geopolitical tensions de-escalate quickly. If you take the White House's rhetoric here, unless we fully stand down, and even if we do, there's no guarantee that Iran is going to let go of the chokehold in the Strait. I don't know how this de-escalates. I truly don't, and I'm open to hearing suggestions and thoughts from any of you out there in watcher viewer land. Shout out to my friends over on Instagram and those of you over on other platforms. Let's see here. Oh, I got to join Twitch, by the way. I've been trying to put that together, but it's just a whole technological challenge for me because it's not my thing, man. But anyway, long story short, what we're going to do is look at that as well. Oh, Sean, Can Pop made it. Missed you Friday. Missed you Friday. Yeah, I missed you too, buddy. It felt really weird not doing a show on Friday, especially because I really wanted to do one. Memory of a goldfish. I feel you. I'm worried, but can't stop and give in either. No, I don't think anyone should stop and give in. I think everybody should be cognitively aware of how society is changing. Let me forego the rest of the trending topics and get into some examples of what I'm talking about here. So this sounds a little bit less like doom porn and a little bit more like market reality. Mark Zandi posted this. I think it was earlier today. I've met Mark a couple times. Pretty good dude. But I'm going to read this directly because it's valuable. And then I'll show you the chart, okay? So we have a year's worth of economic data since Liberation Day when President Trump announced much higher tariffs on most imported goods and countries, which has since been ruled unconstitutional. So that's a whole different thing. Now they're setting up reimbursements. Not to say that a whole lot of that's going to change. Wait, what? Wife got laid off mid-maternity leave from private equity company. No, Sean, I'm so sorry to hear that, buddy. It's a bizarre market, but giving her financial acumen and background, she may be able to get a job pretty quickly. But if you want any help, shoot me an email, brother. I'll introduce you to some contacts, and hopefully maybe you guys can make something happen. Despite my disdain for private equity, there's a lot of people out there that are good people that I know pretty well that might be able to make some introductions. So let me know, okay? Since that day, job growth has come to a standstill, with only the non-traded healthcare industry being meaningful to payrolls. Also, since that day, inflation has accelerated, with the consumer expenditure deflator increasing at a 3% year-over-year pace, up from 2.5% before the tariffs, and well above the Federal Reserve's target of 2%, which we're going to put out a short on here just a couple minutes from now after this is over, where Saied meaningfully says that that is an illogical conclusion to think that we're going to get to 2% anytime soon. And the trend line doesn't look good, especially as the economic fallout from the Iran war hits with full force and continues to be uncertain, as we saw in today's headlines, right? The higher energy and other commodity prices caused by the war threaten to do even more economic damage than the tariffs, further undermining growth and pushing inflation higher. So I want to really hone in on that last portion there, okay? I'm going to read it to you again. The higher energy and other commodity prices caused by the war threaten to do even more economic damage than the tariffs, which I'm going to show you now, and it should be worse than this, okay? Further undermining growth and pushing inflation higher. The U.S. economy is resilient, but just how resilient is set to be tested. And I like that conclusion. He is not being like a doomer, right? He's just saying, like, look, these are the facts, like it or not, and the geopolitical conflict from the war, this oil strain, this energy strain, is going to be more impactful than we saw with inflation, with the tariffs. Okay, so this is post Liberation Day. Liberation Day is this one right there. Okay, now what happened post Liberation Day is this green line is inflation. Okay, inflation is going that way. Pretty clear. Jobs are going that way. This is all post. Okay, Liberation Day. This is presumptively tariffs kicking in and the impact happening now. For those of you who may not be familiar with what the Fed does, these are going the opposite way that they should. And they're going the opposite way they should from April 25 to now May. Okay. And this chart goes to January, February, March. So it goes to March. All right. So you're a couple months back and it's still going the same direction here. You're effectively a year out, and now you got jobs going the wrong way, and you've got inflation going the wrong way, and you haven't had the impact of this oil energy shock hit the markets yet. You haven't seen the full pressure of tariffs yet, and you have AI on the horizon, which is going to meaningfully impact at least some jobs on some level. And you need to look no further than my last post on Instagram, which, you know what, I'll share with you guys now because I think it helps a little bit here. Let's go to Instagram and I'll show you a little bit about what I mean with jobs. And I said, look, it's not going to impact everybody's jobs, but it's going to impact enough jobs to where, let's see, not now. Let's see here. Go to my profile. There we go. Okay. So here's the profile, and there we are. All right, this was the last post that I made. It's a carousel. Tech jobs are bleeding. 81,747 layoffs in Q1 2025, the highest quarterly total in at least 2 years, and layoffs more than doubled from Q4 2025 and surged 580% since last quarter. That's a big jump. That's just a big jump, dude. March was the worst month yet. 45,800 job cuts announced in March alone. Again, that chart that I just showed you from Zandy, which we'll go back to, covers in through March, the single worst month for tech employment in over 2 years. Again, not cataclysmic, not catastrophic, just only 2 years, but still noteworthy. This is real data. Okay, Meta, Microsoft, who's next? Meta is cutting 8,000 employees. Microsoft, taking a much more gentle approach, which I respect, is pushing voluntary retirement for 7% of the U.S. staff, with forced cuts to follow if targets aren't met. And I will be honest with you, I don't expect targets to be met at Meta. They have not. Microsoft, not Meta. Meta, different story. Microsoft has not been innovative. They're too large to be flexible, and they haven't been innovative in a very long time, and I think that's showing up in the stock price. AI is replacing your team. Tech giants are shifting from spending money on employees to spending money on compute. That compute gives them efficiency, so whichever one drives more efficiency over time will be the winner. Whether that's a mix of humans and AI, or it's just more AI, less humans, remains to be seen, and I think that's where a lot of the skepticism of AI being so disruptive comes in. That's what I posted as far as the job markets go. So you can clearly see here, inflation going the wrong way, jobs going the other way, and you've seen a pretty palpable disconnect that my friend Mark Zandy here is talking about, and the worst has yet to come, okay? That's the problem here. Let's go over to this article I saw from MoneyWise. I was scrolling Apple News last night. It's in the show notes here. A veteran market strategist is calling out a disturbing trend in the U.S. labor market no one is talking about right now. And I got to tell you, this one was a little meh in the beginning, but it picked up here. So Inflation and the unwavering high cost of living remain the biggest issue plaguing most Americans. One, it's also a particularly lucrative time to be a CEO in the United States. Okay. Corporate profits have exploded, reaching a record $3.8 trillion. Two, okay, these are all footnoted down below. So I suggest you read those footnotes because I've checked them and they're all valid sources, despite the fact that this is a MoneyWise syndicated article to Yahoo News. After tax in the final quarter of 2025, that figure is nearly double where it stood in mid 2020 following a sharp post pandemic spike. There was one particular statement here I wanted to read to you guys here. Let's see here. Here we go. To some, that kind of meteoric rise signals economic strength and market efficiency following the lockdown years, perhaps in part by developments in AI. We don't know, perhaps, right? But one tenured economist says the data in context points to a potentially concerning shift in how capitalism is functioning. This harkens back to Ray Dalio's New World Order change, and I don't know that I disagree with it, but it's certainly an interesting spin that I hadn't thought about before. Jim Paulsen, who has served as chief investment strategist at firms including Wells Capital Management and the Luthold Group, examined the recent profit boom alongside changes in GDP and employment. In a Substack post, which is also linked in the footnotes, on Monday, he called the disparity disturbing yet not widely discussed. U.S. capitalism has historically been successful because its primary component parts have always been codependent. He wrote, have innovations lessened conventional U.S. economic codependency? Profits are now out of sync with GDP growth and job creation. And this is the part that's really valuable here. Paulson noted that while executives have celebrated unrelentingly strong gains over the past 5 years, and you've seen this on CNBC, you've seen executives at conference talk about this, and it's clearly being celebrated. Oh, the economy is so resilient. Well, okay, this is what we're talking about right now, all right? So the labor market has been weak. Job growth in 2025 served as the slowest since 2020, and before that, the 2009 Great Financial Crisis. Despite a stronger than expected 4.3% uptick in real GDP, the third quarter of last year, growth slowed to a mere 0.5% in the final quarter. Nominal GDP fell, goes on and so on and so forth. These indicators have historically moved in tandem with one another, but automation and other factors appear to be disrupting that relationship. So basically what this distills down to is they're trying to suggest that U.S. corporate profits are moving in one direction while employment is moving the other direction. CEOs are getting paid more in the other direction, but everybody else seems to be making less relative to inflation. And these two things generally aren't connected. There used to be a spreading of the wealth where because the companies were making more money, we were all making incrementally more money. Sure, CEOs got paid more of a percentage, but we all made more. Well, that isn't happening anymore. Not only are the jobs scarce, but if you have a weak job market, right, you can pay employees less because more people need jobs. And we've already just talked about the layoff section we went through here. So this is a breakdown, according to this, of capitalism. And I hadn't really thought about it that way, but it sure as hell feels like something is materially broken in the old traditional ideology of what capitalism was, because that money isn't coming to me, you, everybody else. And I would argue that the lower class has always felt this tightness because of inflation anyway. I think the middle class is starting to feel it in a very different way. So I think that's why you hear a lot of different perspectives from people on how they're feeling and what they're feeling and where they're at and where they're located. It's based on your geography. It's based on your income class. It's based on a lot of factors. Dateflation was really fascinating. I'm going to read this article to you too in parts, tiny bit, because we are pushing up against our time here. Americans say they are dating less as the average cost of a night out to exceed $200. Now, this does include haircuts and all the prep work and all that stuff. But hey, if you're going to go out, be sexy, right? Fascinating that you're seeing the birth rates in the country decline. And now you're looking at cost of dating and people are willing to give up dating, right? Because it's too expensive. So they can have just a general comfortable lifestyle. And that combined with microplastics and toxics. Shout out to the sponsor, joinfridays.com. Hit in the code higher, and hopefully you get your health and nutrition right. But certainly all these things are affecting hormone levels, and because they're affecting hormone levels, they affect birth rates. So people are now willing to give up things like dating, which has gotten to be wildly expensive. And the article goes on. I have a link to it in the show notes for you. But the average cost of dating in the United States is $189. The average, you go on 2 dates a week, that's a car payment, man. According to a survey from BMO's Real Financial Progress Indicator, that's the total bill. It includes everything from money spent on pre-date grooming to the cost of transportation. That's a 12.5% increase from an average of $168 in 2025. Okay, so when we talk about inflation, we go, oh my God, inflation's up 2% on the year. No, dude, just to go out on a date, okay? we forget all that basket of goods bullshit from all the economic reporting and all that other nonsense about, oh, inflation's only up to, no, okay, fuck that. Okay. If you want to go on a date, it's 12.5% more expensive today than it was last year. Okay. That's a huge hit. Most people going out on dates, okay, didn't get a 12.5% salary increase from last year to now. So now their life is just more expensive, right? I mean, that's just what it is. And if you go on 2 dates a week or 3 dates a month, I mean, that adds up. Let's just say you go on a date a week. Let's just say you got game and you disciplined approach every Saturday, Sunday. You have one girl you're seeing and you guys go out every single, dude, 4 times a month at, let's just call it $200, $800 a month on just 4 times a month going on a date. And yeah, there's economically viable, blah, 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 bullshit, bullshit, bullshit. That's the cost. That's nuts. That's 12% higher. Okay, 12% higher on a $1,000 a month if you go on 4 dates. Okay, that's $120 a month, man. I mean, people don't have this type of free cash flow, and that's where things are just $120 a month and just increased costs. So it's crazy. The last one, which kind of breaks my heart a little bit, and I'm going to go over this one really quickly. McDonald's is quietly ditching popular in-store feature nationwide. You want to know what that feature is? You want to know? Fountain drinks. You now got to get them. They cite, oh, it's more efficient and we can get you a better product. The machines don't break down as much, but they're now also selling stuff like energy drinks or dirty sodas, which have become really popular. You mix in some type of milk or creamer or whatever the hell it is, or you mix together different flavors. So a self-serve fountain at McDonald's restaurant, which has always been a staple ever since I was a kid, now going away as part of cost controls for them and part of an image revamp. The company plans to complete the transition away from self-serve beverages entirely in the U.S. dining rooms by 2032, with the change expected to roll out gradually over the next several years as restaurants are remodeled or updated. Damn. Even McDonald's got it like that now, man. That's crazy. LinkedIn, Mark Taylor, what up? But they could make money donating. Yeah, they could. Sean, drinks, food, entertainment included. Yeah, see, lots going on, man. All right. Well, look, I tried to do the show in about 30 minutes or less. I'm a little bit over today, but there was a lot of interesting articles to cover. I appreciate you guys. Sean, you've been great. I love you. Mark, you've also been awesome over on LinkedIn. I sincerely appreciate you. Just to let you guys know that I'm going to try to be a little faster in the cadence just to try to keep things going. C. George, is passing the bar exam hard? I think about becoming a criminal prosecutor, and I'm pretty sure I can do it, but I don't really know anyone that can provide guidance. Well, yeah, it is hard. Let's see. I took the bar the first time right after I graduated law school, and I did not want to be an attorney, so I didn't have like the focus I think I needed for it. 14 years later, I took it again and actually passed the bar exam with the idea that I was going to have a son about 8 years ago now in the future, and I didn't want to look back and say that I hadn't done it, and I knew that I wasn't going to have the opportunity to really do it again with all the business and everything else that I was doing, so I spent a great deal of time doing it. Is it impossible? No. Does it take a lot of rote memory? Yeah. Depending on what state you're in, the way the bar exam works is you can actually have apprenticeships in some states now. I think Washington or Oregon is one of them. Oregon maybe. But once you get past that hurdle, it's a career. Now, is it a guaranteed track to success and wealth? No, it's not. And criminal law isn't for everybody. I probably could not do it, just me personally. I like the business side of things, real estate, but I also have that kind of background. So Louisiana, okay, interesting. Louisiana is an interesting state because they follow French law. They're the only state in the country that does follow French law. So the laws there are a bit different. I have some friends who actually practice criminal law in Louisiana, and I'll tell you that it's a fascinating state to practice there. I think there's a lot of opportunity for criminal defense attorneys in the state. At least that's what I'm being told anyway from people who do pretty well in the state with that. So what I'll tell you is your bar exam would be slightly different than a lot of people, actually more than most, because of how French law impacts Louisiana and the way they still do things out there. It's very much like traditional French law, frankly, with a little bit of American law mixed in. Obviously, federal law being a bit different from a state perspective. But look, if you feel like you can do it, go do it. You'll struggle a bit during year one of law school. It's hard. Year two and year three, you kind of figure it out and you learn to manage the stress. I was working full time when I went to law school, so I went to law school at nights and I did a lot of traveling. And I took summer. There's 2 sessions in summer. I figured out early that if I took a summer, a regular course in a semester, call it 4 to 6 months, and then the second semester, right, 4 to 4 months or so, that I could take in summer 2 semesters work because they had 2 different summer sessions. Basically, I could expedite the path by doing more. So I kind of front loaded all the work and all the stress so that my last year was kind of really, hands off and relaxed. But I never made a lot of money as a practicing attorney. So food for thought. If you're going to be a good attorney, You got to be good in business. You got to be good at marketing and networking and selling yourself. If you don't like those things, you're probably going to work for a firm and get a W-2 job, and that's okay too. So there's no judgment there. Just think about what you want. If you want to email me, you can email me at media@higherstandardpodcast.com, and I'll walk you through some of my experiences if that'll be helpful. But it's not for everybody, brother. But if it's for you, then go for it. Just know that a lot of this is changing with AI. It's going to be very disrupted by AI. All right, that's about it for everybody. I appreciate you guys. Ran a little long today. I apologize for that. But you know what? It's because we had some good articles, and I'm pissed off at McDonald's. I used to love those fountain drinks. It's going to be like the movie theaters. You're like, oh, it was $3.50 back in the day, and now it's like $25 just to get a seat. So anyway, all right, everybody, take care. See you next time.